You're scrolling through Zillow on a Sunday afternoon. It's a modern American ritual. You imagine your life inside these pictures. The backyard barbecues, the kitchen where you'll teach your kids to cook, the front door you'll walk through after a long day. It's the American dream, digitized and delivered to your phone. You find the perfect house, a 3-bedroom ranch in a quiet suburb. You can already picture your life there. You check the price, do the math, and think, maybe, just maybe, this is the one. You get ready to make an offer, feeling that mix of excitement and terror that every first-time homebuyer knows. But what you don't know is that your biggest competition isn't the young couple from down the street or the family relocating for a new job. Your biggest competitor is a computer algorithm with access to billions of dollars. It doesn't need to imagine its life in that house. It has already calculated its value, its potential return on investment, and it's ready to make an all-cash offer, sight unseen. It's the story of how giant tech companies and investment funds began a massive shopping spree for single-family homes, using powerful algorithms to outbid regular people. This is the Zillow Effect, and it's much bigger than just one website. Our story begins with a simple, brilliant idea. For decades, selling a house was a slow, painful, and expensive process. You had to find a realtor, stage your home, deal with open houses, and wait for a qualified buyer, all while paying hefty commissions. Then, in the mid-2010s, a new type of company emerged. They were called iBuyers, which stands for instant buyers. The pioneers were companies like Opendoor, and later Zillow itself with its Zillow Offers program. Their promise was seductive. What if you could sell your house with the click of a button? The idea was simple. You go to their website, type in your address, and answer a few questions. In response, their powerful computer brain, called an automated valuation model, or AVM, would analyze mountains of data, recent sales in your area, property tax records, school district ratings, market trends, and spit out a competitive all-cash offer for your home within 24 hours. If you accepted, they would buy your house directly. No showings, no waiting for mortgage approvals, just a clean, fast cash transaction. They would then do some light repairs, put it back on the market, and sell it for a small profit. They weren't trying to be house flippers in the traditional sense. They were a tech company, aiming to be a market maker, taking a small fee for providing convenience and liquidity. It was supposed to be a win-win. But to make this model work at a massive scale, these companies needed to be incredibly good at one thing: predicting the future value of a house. Their algorithms had to be flawless. And for a while, it seemed like they were. This convenience, however, opened the door for a much bigger and more powerful player to enter the game. It wasn't another tech company, it was Wall Street. Giant private equity firms and investment funds like Blackstone and BlackRock saw what was happening. They had billions of dollars in capital, and they were looking for a safe, profitable asset to invest in. For decades, they had invested in commercial real estate, office towers, shopping malls. But after the 2008 financial crisis, they found a new target: the single-family home. These weren't iBuyers. They had a completely different goal. They weren't interested in buying a house and selling it a few months later for a small profit. Their strategy was to buy thousands, or even tens of thousands, of single-family homes across America and never sell them. Their plan was to become America's new mega landlord. They created subsidiaries like Blackstone's Invitation Homes, which is now the largest owner of single-family rental homes in the United States. They concentrated their purchases in specific fast-growing areas, primarily in the Sun Belt, cities like Phoenix, Atlanta, and Charlotte. They used sophisticated technology, not just to buy, but to manage their vast empire of homes. Algorithms determined rent increases. Centralized call centers handled maintenance requests. They were applying a cold industrial scale to the deeply personal business of housing. So now you have two types of corporate buyers flooding the market: the iBuyers, who are trying to flip houses fast, and the Wall Street landlords, who are playing a much longer game. And for the average family trying to buy a home, the consequences have been devastating. Imagine you're that family again, making an offer on your dream house. You've been pre-approved for a mortgage, you've written a heartfelt letter to the seller, and you've offered $10,000 over the asking price. But then, an all-cash offer comes in from a company you've never heard of, which is actually a subsidiary of a massive investment fund. They offer even more than you did. They waive the inspection. They can close in a week. As a seller, which offer do you choose? The one from the emotional, financially stretched family with a mortgage that could fall through? Or the one from the guaranteed, emotionless, all-cash machine? The answer is obvious. Studies have shown that in the neighborhoods where these companies are most active, home prices have been pushed up significantly faster than the national average. They create intense bidding wars, pouring gasoline on an already hot market. They reduce the number of available homes for sale, because every house they buy and turn into a rental is one less house an American family can buy to build their own equity and future. This has created a generation of permanent renters. People who make good money, who in any other era would be homeowners, are now forced to rent, often from the very same companies that outbid them for the house they wanted to buy. They are paying off a Wall Street firm's mortgage instead of their own. But this story has a dramatic twist. It turns out that being a tech-powered house flipper is not as easy as it looks. And the biggest player of all was about to learn that the hard way. Zillow, the king of real estate data, was convinced its algorithm was the best. They poured billions of dollars into their Zillow Offers program, aiming to become the biggest iBuyer in the country. They started buying up thousands of homes, confident their computer brain could accurately predict the market. But then, something went wrong. Terribly wrong. In 2021, their algorithm, which was tuned to a relentlessly rising market, failed to predict a slight cooling off. It started overpaying for houses. It was buying high, and then being forced to sell low. The losses mounted fast. In one quarter, Zillow lost over $300 million. They had thousands of homes on their books that were now worth less than what they paid for them. The dream was over. Zillow announced it was shutting down its iBuying business entirely, laying off 25% of its staff, and writing off over $500 million in losses. The company that knew more about American real estate than anyone else had been humbled. They had proven that even the most powerful algorithm can't always predict the chaotic, emotional, and unpredictable nature of the housing market. The spectacular failure of Zillow Offers was a warning sign. But it didn't stop the trend. While Zillow got out of the game, other iBuyers like Opendoor are still active. And more importantly, the big Wall Street landlords, with their long-term rental strategy, are still buying. They don't care about small market fluctuations. Their model is built on the belief that rental demand will always be strong, especially if they own a huge portion of the available homes. Today, in some zip codes in cities like Atlanta, institutional investors own more than 20% of all single-family homes. They are a dominant force, shaping the market in ways that most people don't even see. So where does this leave us? It leaves us in a new America, where the path to home ownership is no longer a given. It's a competition, and the rules have been changed. The dream of a white picket fence is being replaced by the reality of a long-term lease agreement with a faceless corporation. The very idea of a neighborhood, a community of homeowners, is being eroded and replaced by a portfolio of assets managed by an algorithm. The Zillow Effect, in the end, wasn't just about looking at houses online. It was about technology opening the door for Wall Street to walk in and buy the American dream right out from under us. The question we all have to ask ourselves now is, what happens when our neighborhoods are no longer owned by the people who live in them, but by the companies that trade their shares on the stock market? What happens to the soul of a community when every front door has a price per share attached?